Hi. In this video, we're going to be doing a demonstration of how to record transactions. So if you have not yet printed out the worksheet, please do that. It's in the Please Print folder in Chapter 2 in Blackboard. And we'll also be using this document that we used in our last mini lecture, Chapter 2 Essentials. Please have that handy as well. If you don't have them handy, then please stop this video, get them, and return when you do have them. Okay, let's take a brief review of what we did in our last mini lecture. Let's flip to page 3, how to record transactions using debits and credits. We said the 3 steps are to first analyze the transaction. Picture the activity. Name what's exchanged, what 2 or more accounts are affected, then analyze the effects on the accounting equation. The next step is to journalize the transactions. The journal is called the Book of Original Entry because it's the first place where transaction information is recorded. And to record things, we use the rules of debit and credit. Assets are on the left side of the accounting equation, so we increase on the left side, which is called the debit side. Liabilities and stockholders' equity are on the right side of that equal sign, so we increase on the right side, which is called the credit side. If we want to decrease an account, we simply do the opposite. We would credit assets and we would debit liabilities and stockholders' equity. We learned how to create a journal entry. And then finally, the third step is to post or copy the information from the journal entry into the ledger accounts. We go to the cash T account in our ledger and we post a debit or an amount on the left side to the cash account. And then we go to common stock and post an amount, $10,000, to the credit or right side of the common stock account. And those are the 3 steps. So now let's take a look at our worksheet. And it states, for each of the following transactions of Spotlighter Incorporated for the month of January, indicate the accounts, amounts, and the direction of the effects on the accounting equation. And we have this form here, which we'll call a transaction analysis form. We're going to be using this in the first few chapters, but after that we will most likely not, because this transaction analysis process usually occurs just in our head as we think about the transaction. In these early chapters, it helps to put it down on paper because then we can use the accounting equation to structure it and help us with the rules of debit and credit. Okay, let's take a look at the first one. It's done for us. In A, Spotlighter borrowed $3,940 from a local bank on a note due in 6 months. When you see the word note, what they're referring to is a promissory note. It's a way in which we borrow money. It's a formal written promise to pay principal plus interest at a future date. So Spotlighter is promising to pay the bank $3,940 in 6 months. Now, a note is considered short-term if its length is 1 year or less. If the note will be paid back in longer than a year, it's called a long-term note. So, we picture the transaction. Spotlighter is at the bank, they're receiving money, and they're giving a note. Remember, every transaction involves a giving and a receiving. What are they receiving? Let's name it. Well, they're receiving cash. And cash is an asset, so we'll put it under the asset category. It's increasing since we're receiving it, so we'll put plus $3,940. They're giving a note, and they're promising to pay in the future. That's a debt or liability. So our debts are increasing. We'll put notes payable under the liabilities column, and we'll put plus $3,940 because our liabilities are also increasing. Now remember what we said about recording transactions. The accounting equation has to stay in balance, and it is. The assets, cash in this case, $3,940, equals the liabilities, also $3,940, plus no stockholders' equity. Let's try the next one. Spotlighter Inc. received $4,630 in cash from investors and issued common stock to them. Let's picture the transaction. Spotlighter is receiving cash and they are giving common stock. Every transaction involves a receiving and a giving. Okay, what type of an account is cash? It's an asset, so we'll put it under the asset category. And is cash increasing or decreasing? Well, if you're receiving it, it's increasing, so we'll put plus 4,630. What is Spotlighter giving? They're giving stock or common stock to the stockholders, and that's the stockholders' equity account. So we'll put common stock there, and we'll put 4,630, and we'll add that because the investment of the stockholders is increasing. Now in C, Spotlighter purchased $1,000 in equipment. They paid $200 in cash and promised to pay the rest on a note due in 1 year. Let's picture the transaction. Spotlighter is receiving equipment. And what are they giving? They're giving two things: cash and a promise to pay on a promissory note due in 1 year, which is a short-term note. So we ask ourselves, what type of an account is equipment? Well, it's an asset, so we'll put it under the assets column. And let's put the entire amount that equipment is worth, $1,000. What is Spotlighter giving? They're giving two things: cash and a promise to pay. What type of an account is cash? It's an asset. And is cash increasing or decreasing? Well, we're giving it, so it's decreasing, minus 200. And the other thing we're giving is a notes payable again, and it's due within 1 year, so it's also a short-term note. And that would be for the difference, 1,000 minus 200, or 800. Now let's check the accounting equation. The left side, assets, is 1,000 minus 200, or 800, and the right side of the equation is also 800, because this transaction does not affect stockholders' equity. Now let's take a look at D. Spotlighter paid $300 in cash for supplies. Let's picture the transaction. Spotlighter is receiving supplies. They are giving cash. What type of an account is supplies? It's an asset, so we would write supplies down under the asset column. And if you are receiving supplies, they are increasing, so we'll put plus 300. What is Spotlighter giving? Well, they're giving cash. When you see the word paid, we're talking about paid in cash. So cash is also an asset, but when you pay it, it's decreasing. So we'll show a minus 300. Let's check that accounting equation. On the left side, the assets both go up and down by $300, so there's a total effect of 0. There's no effect on liabilities or stockholders' equity. The accounting equation is in balance. And then finally in E, Spotlighter bought and received $700 of supplies on account. On account means on credit. They're not paying for them now. Let's analyze the transaction and picture it. Spotlighter is receiving supplies. Supplies are what type of an account? They're an asset. And they're increasing since you're receiving them. So we'll put plus 700 here. And we are buying them on account. We're not giving anything right now other than a promise to pay. When we buy anything on credit, we use the accounts payable account for that, for purchases on credit. Our liabilities are increasing. Since we're not paying for them right now, our debts are going up. So we would put plus 700. And our accounting equation stays in balance. The assets, or left side, are 700, and the liabilities are 700. Stockholders' equity effect is 0, so 700 equals 700. Now, a couple of things to remember when you're doing a problem like this in Connect. In Connect, you will not be required to put pluses. You would just enter 700, for example. But you will be required to put minuses when you're subtracting or reducing an account. The other thing is you have to stay on the same line. For example, in B, where you increase cash and you increase common stock, you wouldn't go up to the line for A. You would stay on the line for B. In transaction C, you could have put either equipment or cash on the first line. It wouldn't matter. And the same thing for notes payable, as long as you stay within the 2 lines for C. Now, if we were to add down all the increases and decreases to the assets accounts, they would equal the total amount of liabilities, increases and decreases, in stockholders' equity. So we've just completed our step 1, analyzing the transaction. Now we're going to step 2, journalizing or recording the transaction. We're going to use the rules of debit and credit to increase or decrease the accounts. It's good to keep this handout nearby so that you can refer to our rule here. Remember, the word assets are on the left-hand side of the equal sign, so we increase on the left side, which is called the debit side. Liabilities and stockholders' equity are on the right side of the equal sign, so we increase on the credit or the right side. To decrease, we simply do the opposite. Every journal entry has at least one debit and at least one credit. There's no such thing as a journal entry with just debits or just credits. There's also no journal entries with only one debit or a journal entry with just a credit. You have to have at least one of each. And if you have more than one of each, then the total debits equal the total credits. We start with the date, and of course in our problem we've got letters, so we'll use letters. Then the account to be debited always goes on line 1 with the amount in the debit column. The account to be credited goes on the next line with the amount in the credit column. So let's do this next. Okay, we're going to use the same information. In A, Spotlighter borrowed cash from a bank that they're going to have to pay back in 6 months. If we look at our transaction analysis, we said Spotlighter received cash and their liabilities, notes payable specifically, are going to increase. So we have a giving of cash, a receiving of cash and a giving of a note. We said cash was an asset. Let's see what our rules say about increasing assets. Assets get increased by debiting. Notes payable is a liability. That has to be increased, and liabilities are increased by crediting. So we'll put cash on our first line because the account to be debited goes first, and we'll put $3,940 there. And the credit goes on the next line. Notes payable. And this is a short-term note because it's a year or less in length. The amount goes in the credit column. Now, if it helps you to remember, you can put a plus A there and a plus L there. You wouldn't be doing this in Connect, but it would help us to remember the accounts and whether we're increasing or decreasing them. Our next transaction. In B, Spotlighter received cash and they gave common stock. Cash is an asset. cash is increasing. We increase assets by debiting. That means put it on the left side of the account. We're giving common stock. Common stock is a stockholder's equity account. The investment of the stockholders is increasing. To increase stockholders' equity, we credit. So our journal entry is to debit cash to increase it and credit common stock to increase that account. The debit always gets listed first. Cash, which is an increase to an asset, gets debited, $4,630. And common stock, the account to be credited, goes on line 2. That's a stockholder's equity account, and the amount goes in the credit column. Notice how we've got one of each, a debit and a credit. When you have a transaction that only affects 2 accounts, these amounts should match. Let's take a look at transaction C. Spotlighter purchased $1,000 in equipment, so they received equipment, and what are they giving? Cash of $200 and a notes payable for the remainder that's due. So they're receiving equipment. Equipment is an asset, and if you're receiving it, it's increasing. How do we increase assets? We increase assets by debiting, putting amounts on the left side. Let's put that right down here. For the full 1,000. And what are we giving? Well, we're giving both cash and the promise to pay using a note. We're giving 2 things. Well, in this case, cash is an asset, so it does go under the asset column, but we want to decrease it. Remember, to decrease, do the opposite. So we will credit the asset cash to decrease it. That will reduce cash by $200. Put the amount in the credit column. And we're going to sign a note for the remainder of the amount due. And the note is due within 1 year, so it also is a short-term note. 1 year or less means it's a short-term note. And our debt is increasing. How do we increase liabilities? By crediting. So we'll credit notes payable for the rest of the amount that's due. So this is called a compound. I'm sorry, you can't see that. This is called a compound journal entry because there's more than one debit or credit. When this happens, the total debits must equal the total credits, and they do. If we had more than one debit, we would list all the debits first with the amounts in the debit column, and then we would list all the credits with the amount in the credit column. And the total debits would have to equal the total credits. Let's take a look at D. In D, Spotlighter paid cash and received supplies. Supplies is an asset, and supplies are increasing. Remember, our rules say that assets are increased by debiting, and the debits go on the first line, so let's write that in. 300 with the amount in the debit column. And they're paying out cash, which is also an asset, but we want to decrease cash. And the rules say to decrease, do the opposite. If you want to decrease the asset cash, you would credit. So we will put credit on, cash on the next line with the amount in the credit column. And then our final journal entry. Spotlighter bought and received $700 of supplies on account, which means on credit. So they received supplies. Supplies are an asset and they are increasing. So to increase assets, we debit. Debits go on the first line. The amount is $700. We put that in the debit column. And the purchase is on credit, on account. They're not paying for it. they will owe for that. So we call that an accounts payable, which is a liability. And our rule of debit and credit says that to increase liabilities, we credit. So that will go on the second line. Okay, so we've completed recording all of our transactions. As I mentioned, in the real world, we wouldn't be using letters, we would be using dates. We have a debit and credit, at least one of each, for all of our journal entries. And see, we had more than one debit or credit in this compound entry, so we have to make sure the total debits equal the total credits. So we've completed step 2, journal entries. That's really the hardest of the 3 steps. Now step 3. This is simply copying. We're going to post or copy the transaction from the journal into the ledger accounts. Remember, all of your accounts, every single asset, liability, or stockholders' equity item has its own place to record increases and decreases. We call those accounts. And in the real world, there would be a book called the ledger, and there would be a page for every asset, liability, and equity. The assets are in there first. They're assigned account numbers beginning with a 1. Then liabilities are assigned account numbers with a 2. Stockholders' equity accounts are assigned account numbers with a 3. Revenues with a 4. And expenses with a 5. We're not going to waste that much paper, though, so we're just going to use the T's to represent each account. And I've put them in the column that represents the type of an account they are. So let's go to our first transaction and let's post this, which means copy from the journal to the ledger. The first transaction says go to the cash account and put a debit or left side entry of $3,940. So we'll go to cash and we'll put $3,940. And we're going to use, normally we'd use a date. In this case, we're going to use the transaction letter, the A, to represent that posting. Now in the real world, we'd take an account number and we would put it back here in the posting reference column. I'm just going to put a check mark here so I remember that I posted it. Connect will not expect you to do that. Now we go to notes payable. We're going to put that $3,940 on the right or credit side. However, Connect will expect you to put the A's, B's, and C's down, etc. Our next transaction in B says go to cash again and put $4,630 on the debit or left side. Then go to common stock and put $4,630 on the credit or the right side. In C, it says go to equipment and put $1,000 on the debit or left side. Then go to cash and put $200 on the credit or the right side. Then go to notes payable and put $800 on the credit or the right side. Our next transaction says go to supplies and put $300 on the debit or the left side. Then go to the cash account and put $300 on the credit or the right side. And finally, our last transaction tells us to go back to the supplies account and put $700 on the debit or left side. And then to the accounts payable account and put $700 on the credit or the right side. And there we go. We've posted to our ledger T accounts. So that's the end of this demonstration. The next thing to do would be to watch the next mini lecture, and it will teach you how to calculate account balances, to do a trial balance, and then a classified balance sheet. Have a great day.